Morning, and thank you for being here, guys. Today's presentation is Are You Well Protected? Life happens, expect the unexpected. All right, so who are we? Experience the Symmetry difference. So basically, Symmetry Financial Group in the last 6 years has been ranked among the top 5,000 fastest growing companies in the United States of America. We're a team of agents dedicated to educating families, employers, and entrepreneurs on the benefits of advanced markets to facilitate tax-free wealth while protecting what matters most. Corporate is located in the state of North Carolina. Again, we have a nationwide footprint of 6,000 agents strong, and we service the entire United States and Puerto Rico. So a little bit about me for those that don't know me. My name is Michelle Reyes. My player profile is such. I've been an entrepreneur since birth. Uh, was a physical education teacher for about 15 years for the Board of Education in New York. In Miami, I did business education for about 7 years. Then went on to become a real estate broker associate. With eXp Realty. During COVID, I added insurance services to our scope of services, and I'm a field underwriter with Symmetry Financial Group. So what do we do? So basically, we're protecting life's journey from birth to retirement and beyond. We cover various general life insurance products, health insurance, and today we're covering asset management and wealth strategies utilizing an IUL, which is an Index Universal Life. How do we do it? We're partnered with over 30 top-rated insurance carriers, many of which you'll probably recognize on this list. Okay, so today we have a big problem in America. Our debt in the United States as a nation is $31 trillion. It's 35,000, yet the median price of a new home is 448,000. Those numbers are not working. Taxes are going up, and we have serious issues going on with the nation being in debt. Most families are not insured, underinsured, and or living paycheck to paycheck. That is a fact. They say 33% of Americans have no retirement savings. I don't know where you are in this chart, but I ask you to look in the mirror. And if you don't like what you see, what can you do about it? You can start today putting something immediate in place for your family and for yourself. So, savings at retirement. They say most people, their lifetime income between birth to 65 years old will be about $2 million. Yet at retirement, at age 65, funds at retirement is only like $60,000. Is this the American dream? To see how much you need to retirement, what you can do is go to calculator.net and click the retirement tab and play with the numbers for yourself so you could know how much you need to start saving now to achieve your retirement goals of 65 to 85 years old. So here's the facts about life. What are your savings options throughout living? You have three different buckets, and the question is, where has your money been living throughout your whole life? Has it been always in the tax-free bucket? Is your money tax deferred, or is all your money taxed? Let's look at that. Tax-free, we're looking at IUL and Roths. Tax deferred, which means you pay later, like 401s, 403s, 457s, index individual retirement accounts. Taxable, basically everything except the air we breathe is free. stocks, bonds, CDs, mutual funds, savings accounts, real estate, food, vehicles, all of that is taxed. So everything that we do is taxed. So what can you do about it? So what can you do about it is you can look and seriously consider at, is an index universal life right for you? You must qualify for it. But if you do, you're going to get significant tax-free savings and retirement. They say the person who understands the math will always win. And usually that's the bank and the IRS. Until now, that is. So just like technology advances every day to something better, faster, smaller, cheaper, so has your options for insurance changed since the last 1900s. The IUL offers permanent life insurance with the opportunity to earn market-like returns inside the policy tax-free. So looking at the evolution of life insurance, it first started with a little term insurance, and basically the idea was protection. Then in the 50s the whole life came about, and the interest there was cash value, and then it evolved to universal life, which offered a little more flexibility. And then in the 80s the variable universal life was born, and people liked it then because of the possible growth that they were seeing back then. And then in 1997 the IUL was born, and they added the component of guarantee no losing money. Also, you get the best of everything in the 5 year period. You get the protection, cash value, flexibility, growth, and guarantee no loss. The first company to offer it in 1997 was Transamerica. And no, even though you might have never heard of an IUL, there's 52 other companies now offering these types of policies, and more joining the mix every single year. So, what are the key benefits? This is a lot of benefits. I just want you to look at what an IUL. So IUL is like a savings on steroids account. You have the option of opening up a bank account and put that same money in a bank account. And I just want you to think about this. When it's in a bank account, it's not insurance. There's no protections. If you put $10,000 in the bank and you withdraw $10,000 tomorrow, that account now has zero. But if you had the money in this cash accumulation policy, if you put $10,000 in and you borrow $10,000, the cash value would still be $10,000. So that is pretty incredible. So here we go. Lifetime coverage. Regardless of what happens later in life, you're guaranteeing your insurability. If something happens, you get cancer, you get a stroke, you get a heart attack, you already have insurance, so you don't have to worry about this later on in life. Most people, by the time they hit 65 years old, sadly have something, some ailment. And 80% of the time, it's not covered by the medical insurance. So you have your access to money tax free, where you don't pay any capital gain. You have flexibility, you have security, you got support, and you got protection. You cannot say this about your bank account. So right here is why you should act immediately. If you have money in the savings account, that is awesome. I commend you for that. What I'm recommending is you take some of that money and you put it in an environment where you have forever protection and cash accumulation and the possibility of creating a legacy. So how does the IUL work? So first of all, you're making a premium payment every month. From that amount of money that you're putting in, there is some cost of insurance, but the bulk of the money is accumulating cash value. The next thing that happens is, as the money builds, you have the ability to withdraw or borrow against those funds. We always recommend that you borrow, because when you borrow, the cash accumulation value stays the same. If you do a withdrawal, that actually lowers the amount of the cash value. And the fourth component of this policy is the death benefit that would pay out to whoever the beneficiary is. But here's an example. $100,000 in a regular stock account and it drops 15%, that means your money's down to 85,000. If you had that same amount of money in the IUL, If the index dropped 15%, you would still have your $100,000 guaranteed minus any fees. But here's the best part. Your same index grows 15% the next year in your stock account, you would be at 97,750, almost back to where you started. But with the IUL, your money didn't lose money. So you would actually have 115,000. So the floor prevents you from losing money. And more importantly, losing the time trying to regain your losses whenever the market drops. This is a quick example of the S&P 500. Why people are putting in here? Where do you see these type of numbers? 9.5% cap, 13.5. 13.5% cap. In a regular bank account, you are not seeing these type of interest rates. This is an example here of the IUL in the blue. It's never lost money historically in the last 20 years and has reached levels of higher than 12%. Now, today, many people with what's going on in life are trying to figure out where the best place for their money is. And a lot of people will put their money in stocks and bonds. Some people will put their money in real estate. And for the people that do put their money in real estate, I think that's an awesome choice. But two things. Number one, the real estate, the value, usually doesn't increase at the secured pace that it can in an insurance policy. And the most important thing is that the real estate is not liquid. So if you needed money, you can't borrow against a brick without qualifying and taking out a loan and doing a refinance. If you had that same money in the insurance policy, you don't have to get approved for a loan. It's your money. You can borrow whenever you want. And the interest rate is generally at like 5% when you borrow money. And that's pretty great. And as far as you don't have to worry about qualifying for a loan, you have money in your policy for emergencies, for different goals, for vacations, for retirement, all tax-free. Question I have for you guys. When do you think you need the most amount of money in life? And I would say that is when you're 65 to 85 years old, because at 65 to 85 years old, the medical care industry right now is so expensive that if you can't do your daily living activities and you don't have family that's taking care of you, then you're on the government plan. All right, so there's three sources for retirement income. Most people, these are your three options. You save it, you get a nice pension from your job, and Social Security. These are typically the three sources. So let's look at this circle really good. Pension. I don't know about you, but most of the people that I know are working for companies that are no longer giving a very generous pension. Most people today will not be in one job for the rest of their life. Most people will jump between 3 to 10 jobs by the time they're 65 years old, which means benefits usually don't carry over when you get terminated from a position or you quit a position. And then as far as Social Security, that bubble I showed you earlier, the government, the world, where in the United States of America, we're over 300 trillion in debt. So that being said, you can't really count on Social Security. Social Security is probably going to be depleted by the baby boomers, whom are right now 65 to 85 years old. So in this scenario, saving $100 a month, $100 a month times 12 months, that means you would be saving 1,200 a year. 1,200 a year per year for 20 years. That means you would have 24,000. So my question is, do you think saving $100 a month only is enough? Really? Well, it's better than nothing. But the best way to do it is to even save 200 or 250 a month or 500, and then there you're creating a true savings retirement account, and you have complete power of it. I want you to look on the slide to the bottom right. It says living in poverty today. We have over 43 million people living in poverty, and we have over 27 million people living without insurance. So you saving versus a pension. I want you to focus here where I got this little pig. So with a pension, the contribution is decided by your employer. Today, they're just trying to give you less and less to zero. The employer controls the investments. Pension benefits are based on salary and tenure. If a company fails, employees may not get their full benefits. To find out how much you need to save for retirement, you can go to calculator.net and input how much you want to have at 65, your age now, and saving whatever amount. It's going to tell you what you should be saving per month. And then we can go and put that money into one of these policies, the Index Universal Life. All right, some people here may have a 401k, and I just want you to be aware of some of the advantages and disadvantages of 401k. So there's a lot of them. So first of all, with a 401k, you're not protected against downside protection against the market loss or downturns. You don't get tax-free death benefit on it. You don't have tax-free distribution. You don't have access for funds without penalty before the age of 59 and a half. You don't have guaranteed minimum returns. You don't have living benefits, and you don't have leverage access to the cash value. These are all the things you can get with the IUL and you can't get with the 401k. So question is, if you have a 401k, probably if you're depending on your age, you can't touch that money until you're 59 and a half. But what you can control is if you know all these negative side effects, will you keep putting money into it? The only way that I see that is when it's really, really powerful with the 401k is when your employer is matching you for every dollar. Definitely that's a great advantage. But at the same time, I would say there's a couple of moments on some of the 401k policies that you're allowed to withdraw some money without penalty, or you have to look at it carefully. But maybe you take the money, take it out from the 401k, the money that you're allowed to take out, and put that into the IUL. So you decide if you have a 401k, these are your options. To learn more, set an appointment. We can go over your 401k and see if, what can be done to make sure that you're maximizing your saving dollars. A little example here on this chart, you can look yourself up. So we're going to pretend you are between the ages of 20 and 40. After 40 doesn't really make a lot of sense unless the person is going to contribute a significant amount. And it might not be the best arena. I would possibly recommend another route. But for now, let's just pretend you're 20 years old, putting $100 a month. Basically, you would have a death benefit going in at 198,000. The value of that $100 a month when you're 65 years old would be 233,000. By the time you're 85, it would grow significantly to 924,000. So you decide, in this example, you put $54,000 in, and by the time you're 65, the cost of insurance was really free when you look at it that way. Okay, option B, save $250 a month, 20 years old. You would be going in with a face amount of 527,000. That means if something happened to you the next day, that is what the family would get as a beneficiary. If you continue putting the 250 a month, let's just say nothing happens to you and you live a very healthy life, so you're putting 250 a month. At the age of 65, that would accumulate to $621,000 into that account, yet your total investment was 135 $65,000. So in this example, I show again that by the time you're age 65, the cost of insurance would have been free, yet you set up a legacy because now when you're 85 years old, that money will grow to $2.4 million. And the death benefit at age 65 will be 758,000, meaning between the age of 20 and the age of 65, whether you got cancer, you got a stroke, you got diabetes, whatever disease you could possibly get will not affect these numbers because you are already pre-qualified and you already have this plan in place. Last option is for the bold that want to do the Walt Disney, Ray Kroc, and the strategies that the rich use. This is how they do it. First of all, not everybody qualifies. You have to prove that you have a good health, and you have to prove they do a criminal background check. So it's a very serious business and it is a very serious investment. But at the same time, it's a strategy that most people didn't even know existed. So at 20 years old, let's pretend you put $500 a month. So first of all, the death benefit on that, which is the face amount initially going in, is over $1 million. By the time you're 65 years old, continuing to put $500 a month, by the time you're 65 years old, you'll have $1.2 million there waiting for you. Now, mind you, your total investment was $270,000. So again, an example where by the time you're 65, the cost of insurance is zero. Again, summarizing this all up, the Index Universal Life highlights why you should have the IUL. 1, it's like savings on steroids. 2, you got leverage. 3, residual income. 4, tax-free advantage. 5, living benefits. 6, tax-free deferred growth. 7, tax-free distribution. 8, liquidity. 9, private ownership. 10, there's no 59.5-year-old rule. Number 11, it's a real estate multiplier. 12, you could become your own bank. And so this is an entrepreneur. Did you know Walt Disney, when he wanted to do his theme park, no bank in America would give him the loan. And the way that because of the liability associated with the theme park, and the way he achieved this goal was he borrowed against his life insurance policy. Ray Kroc did the same thing. He saw McDonald's as being all over the world. The McDonald's were happy with 10 locations. The Ray Kroc guy told them to buy the land underneath the McDonald's. They didn't listen to him. They fired him. At the end, he had an insurance policy. He utilized those funds to buy the real estate underneath the McDonald's, and he forced the McDonald brothers to sell to him. And not only did he create a McDonald's everywhere in the world, but it's actually one of the most powerful business models in the world because it's run by teenagers and it's $1 trillion business. So what you might not know is where banks actually invest their money in. So there's something called BOLI, which is bank-owned life insurance. And the truth is, banks invest in insurance policies and insurance companies. So here are some on the right. There's a list here. The question is your bank one of the banks on this list? And if your bank is investing in insurance, don't you think you should? I thank you for being here today. For a free illustration, you can just dial 305-956-6825, or I'll give it a minute here so you can screenshot the info on the screen. And basically, thank you for being here today. And lastly, we are growing nationwide. This is a digital agent on demand business. We're nationwide and in Puerto Rico. So if you're looking to work remotely and would like to make a difference, helping people have the right protection in place for their families and for their assets, definitely reach out to the info on the screen. Thank you.